Good morning, and thank you for joining us today for our webinar on small business taxes. My name is Brittany Watson. I am the Marketing and Administrative Assistant for the City of Seguin, the Economic Development Department. I'm going to go ahead and turn it over to Annie Hudspeth with the SBA to introduce today's speakers.
Good morning, good morning, and thank you, Brittany, for having me today. As Brittany mentioned, my name is Annie Hudspeth. I am with the Small Business Administration San Antonio District Office. The San Antonio District Office is committed to fostering economic growth by providing assistance to small businesses that are located in its area of operation. The SBA San Antonio District Office spans across 55 counties within Texas. The San Antonio District Office is located in the heart of San Antonio in the Hippolyto Garcia Federal Building, across the street from the Alamo. The San Antonio District Office offers programs and services to help small businesses flex their financial fitness. These tools help start and/or expand a business, create jobs, as well as seize new opportunities with government contracts, thus driving the economy towards growth. Technical assistance is also available through the SBA's resource partners, such as SCORE, Small Business Development Center, Veteran Outreach Business Centers, and Women's Business Centers at no cost to you. If you're a veteran, SBA has classes called Boots to Business to assist with your transition from the military to civilian business ownership. For additional resources, please visit our website for pre-recorded trainings on different business topics, local resources, and to view our resource guide. Due to the pandemic, there are several temporary programs available, and I'd like to share those with you. Congress intended the funding of COVID-19 economic aid to the hardest hit small businesses. We have the Paycheck Protection Program, better known as the PPP. This program is ensuring more small businesses can keep their employees on payroll and maintain their business operations during the COVID-19 pandemic. This is 100% forgivable if you use the proceeds as intended, 60% for payroll and 40% for eligible covered expenses. These loans are through participating PPP lenders, and you can apply through May 31, 2021. The SBA is also providing debt relief payments to current SBA-backed guarantee loans on behalf of the borrowers of traditional SBA business loans, including 7A, 504, and microloans. If you're not receiving this, please contact your lender or the SBA to see how SBA can make your payments for you. We also have the Economic Injury Disaster Loan. This is a direct loan from the SBA and provides working capital economic relief to small businesses and temporary loss of revenue due to coronavirus. Just recently added, we have also added a declaration for the Texas freeze. So if you were personally or your business was affected by the freeze, please be sure to visit our website for disaster assistance. The EIDL loans for the COVID relief are being accepted through December 31 and come with a 24-month deferment period from the date of the note. We also have the shuttered venue operators for live venue operators, promoters, live performing museums, zoos, aquariums, and so many more. So please visit our website for more information on the shuttered venue operators grant. We also have the Restaurant Revitalization Fund for food trucks, food carts, caterers, restaurants, any business that, any establishment where people assemble for primary purpose of being served food or drink. So please visit our website for more information on that as well. And you'll always find the most up-to-date information on sba.gov/relief for our relief products, and then also sba.gov for our normal 7A 504 loan programs. Please keep in mind the information provided today is current as of today and may change, so please continue to visit our website. Next, I'd like to please help me welcome our next presenters and friends, Rita McDaniel and David Plemons of David Plemons CPA firm right here in San Antonio. David and Rita will cover small business taxes Usually when I'm out in the public and I get to visit individuals in small businesses, I always say a CPA is one of the top 5 relationships all small businesses need in your small business toolbox. And now more than ever, with tax states changing, the changes of tax states, when a payment is due, it's constantly changing. And right now, you need a CPA more than ever. So I'm going to turn it over to David and Rita. Thank you.
Thank you, Annie. We appreciate it. And thank you, everybody, for being here this morning. We appreciate y'all getting up and taking the time to come listen to what we have to say. Hopefully it will be worth your while. So, go ahead, Rita. We'll just start, I guess.
Yeah, I was trying to click it, but it wouldn't move.
You know what? One thing I just wanted to say, if there's anyone on here that when you're going through your the different business structures, maybe ask them to raise their hand if they're in that one. Maybe that will work.
Yeah, that would be great.
And then if you have questions, do we have a chat feature, or how would they ask questions?
I think they can put it into the chat, or there's a question and answer button down at the bottom that you're logged in, or you can put it in the chat. Either one, I think will.
Okay, so we'll stop
Yes, that's correct.
every little bit. We'll stop and answer any questions relevant to what we just talked about. But first off, we always have to give you the obligatory, everything we tell you may or may not be true type of a tax advice is very, very specific. So you may tell one person to do something and the person sitting next to them would be the exact wrong advice. So all we're trying to do is say, hey, this is generic information. You need to get more specifics probably before you really go out and start pulling the trigger on some of this.
Mm-hmm. Okay. So today we're going to be talking about the different types of entities or business organizations that you can select. We're also going to be talking a little bit about bookkeeping systems and accounting methods, a teeny tiny bit about record keeping and how long you should be able to keep, how long you should keep certain items and the different exceptions that are associated with that. And we're going to touch on information returns, franchise tax, and personal property tax, which is one of the areas a lot of our small business owners are not aware of when they're starting a business. They get these property tax renditions and they get all kind of discombobulated. So we're going to try to provide a little bit of clarity in that arena.
And one thing we're not going to talk about is sales tax. That's kind of outside of the scope of what we're going to do here today. So if you have sales tax questions, we can work with those later, or a really good source is just call the state comptroller's office. They're pretty good about answering your questions.
All right. So we're just going to jump into the types of business organizations, the different types of entities that are out there. So if you, the sole proprietorship, general partnerships. We're not going to talk about limited partnerships right now, just because of the time that we have. We were trying to kind of restructure it, make sure. So if you are a limited liability company or a partnership, then make sure you reach out with specific questions and we can make sure those get answered after the seminar. And then we're going to talk about C Corps, S Corps, and then the famous limited liability company, the LLCs that everybody wants to be. You have anything to add, David?
No, I'm good.
Okay. I wasn't sure before I flip the slides.
Well, the sole proprietor, 10 years ago, most people started off as a sole proprietor, and it's becoming less and less because now people are tending to start as an LLC, but we'll get to that in a minute. A sole proprietor is very, very easy to start. It is the most simple, basic business structure that you can come up with. Basically, you just say, I'm in business, and you are. That's all it takes. You are now a sole proprietor. We're going to talk a minute because we're looking at the chart talking about franchise tax, property tax. We're going to talk about franchise tax at the end, just like Rita said, and the local and county personal property tax we're going to talk about at the end. So save your questions for those. But if you're a sole proprietor and you stand up and say, I'm in business, like I said, that you are. So you have to start keeping a set of books. You need to keep your records So for any of these entities, you need to keep separate business records from your personal financial records. We have a lot of people who will start a business and they're using their personal checking account or personal credit cards to fund the business, and you got personal and business all intermixed. Generally, that's not what you're going to aspire to. IRS is not very fond of that method of accounting. And if you do get audited, they see, when they see the mixture of personal and business, they jump all in that and get all in your business, basically trying to sort the two out, and they're going to claim everything's personal, nothing's business, and you'll have a lot of problems. So number one, we always say, get you an EIN number, even if you're just a sole proprietor. You don't always have to have one, but it's better than using your Social Security on documents that you might have to use. Check out the sales tax rules, go to the state controller. Depending on what type of business you're in, if you provide professional services like a CPA, an engineering firm, architectural firm, you don't worry about sales tax. But if you're selling a product, if you're in the trades, plumbing, electrical contractors, pest control, any of those, sales tax does come into play.
Mhm. So one thing I want to kind of just jump in and say is that we have a lot of conversations with individuals that come in and bring us their taxes, and they were like, I'm not a sole proprietorship. I just get a 1099. I'm just a contractor. If you receive a 1099 NEC for work that you've provided for businesses, then you are actually a sole proprietor. So when David was talking about commingling funds and making sure that you keep your personal and your business separate, even if you are just a single contractor getting one 1099 from one company, you want to make sure that you are still not commingling your funds. You still want to make sure that those things are separate. So I just wanted to kind of put that in there. So, because you're still going to be filing that Schedule C.
Right. So as a sole proprietor, you don't file a separate tax return per se. What you file is a separate schedule, a Schedule C, which is part of your personal tax return. So we tell you don't commingle funds, but you kind of have to commingle your taxes, but it's just the Schedule C is the business. That's the profit and loss of your sole proprietor. Whether you do something and you make $100, whether you make $20, whether you make $20 million, it all goes on that Schedule C if you are considered a sole proprietor. The profit or loss of the Schedule C, let's say you made $100 profit, that $100 is then pulled over to the front page of your 1040 where it gets taxed for income tax. And then there's another lovely tax you get to I'm going to say enjoy. You really don't enjoy it. You get to participate in something called self-employment tax, which is a statutory 15.3% of your profit. So on that Schedule C, you go to the bottom line. If the profit's $100, you're going to get to add another 15.3% of self-employment tax to your federal income tax.
Right. Now it's important to remember that those are two separate taxes. So you have your personal income tax, but then you have the additional 15.3 on the income that you generated from the sole proprietorship. So they're two separate taxes. We get a lot of people that get confused when they get their tax return because they don't understand that there's two. They might not have owed anything on the personal side, but the amount that they owe to the IRS is 100% the self-employment tax. And so it's a little bit hard to wrap your mind around, but if you kind of keep it in your mind that they're two separate taxes that are added, on that portion of the income that you're receiving from the C Corp, from the Schedule C.
Right, and people go, what in the heck is that? Why do I have to pay that? Well, basically that's your Social Security and your Medicare tax. When you work for somebody else, if you look at your paycheck, if you look at your W-2 at the end of the year, they're withholding from your pay Social Security and Medicare tax. Now they're only withholding half of this 15.3% from you, and what you don't see is the company goes and adds the other half. So When you work for somebody else, 15.3% is going into the Social Security Medicare system with your name tagged to it. When you're self-employed or a sole proprietor, you are both sides of the transaction. So you get to play employer, you get to play employee from the calculation and submission of that tax. And I use the term employer, employee. One thing we do want to make clear, as a sole proprietor, you are not an employee. You do not meet the legal IRS definition of employee. You're considered a sole proprietor, which is a different type of animal.
Mhm.
Don't get confused if somebody thinks you should be on payroll. As a sole proprietor, you should not be on payroll. If you hire somebody, obviously they would be, but you as the sole proprietor would not.
Right. So, and the other, the reason that the sole proprietorship is not subject to the state franchise tax is because there is no formal creation with the state. So the state does not require you to report back to them on the income that you're making or from the business. So that's the reason why that there's no state franchise. And what that actually does is it actually provides no legal liability protection for you. So a lot of individuals that are starting businesses are going to select one of these entity types to provide legal liability protection for their business and kind of separate the risk of getting a lawsuit, that they can only attack what's in the business and not get to any of their personal assets, so in a sole proprietorship, you don't have that liability protection from, separating your personal and your business. So if you want to make sure that you get a good insurance, depending on the industry type that you are, to cover any of those liabilities, and then just decide, if the risk of your business is really high, then you may want to consider transitioning from a sole proprietorship into another entity type. So
and that's typically the smart thing, but like she said, it depends on the type of business you're in. Let's assume you're running a food truck and that you're a sole proprietor running a food truck. Your wife or your spouse makes a lot of money. So between the two of you, let's say you got $100,000 sitting in the bank and you got a bunch of personal assets. You spill grease out the front of the food truck, somebody gets hurt, somebody slips on the grease, whatever, they sue you. All of your personal assets are going to be involved in that lawsuit and subject to somebody taking them. So that $100,000 you got sitting over there is at risk because there is no liability wall between you and the company, which some of these other entities build. Now, obviously, we're not attorneys. We're not trying to give legal advice. So if you're worried about some of these, please sit down with your attorney.
mm-hmm.
That's the specifics of the liability. Most people say, yeah, I'm just going to buy insurance. I'm not going to worry about it. And that's good, but all of the time we see insurance companies declining coverage, whether it's the policy required you to stay 12 feet back from the sidewalk and you were 3 feet from the sidewalk, whatever, they're going to find reasons not to pay. And it's always a good idea to double up on your protection, get the insurance plus an entity or whatever it might be. But we'll talk about those in a minute that do give you some.
And the door swings both ways. So keep that in mind that if in any of these entities, like the general partnership that we're going to talk about here, it is just like the sole proprietorship. It's just as easy to start up. There's no legal formation with the state, so it's not subject to the franchise tax. But the door swings both ways. If there's if your wife runs into somebody and they sue you and you're making millions of dollars in your company could potentially be attacked as well. So, I mean, as a sole proprietorship or a general partnership here. So these are the two entities that have no legal formation with the state. So both of these are not subject to the franchise tax. They're both subject to local and county personal property tax that we'll talk about, later. And then depending on the industry that you're in, like we said, we're not going to specifically talk about sales tax today because it is a lot of gray area and really specific to individual businesses and what you do and how you do it, not necessarily the entity that you have selected. So if you have questions about that, like David said, it's good to call the comptroller's office to get specifics on those. And then the general partnership, it does file its own separate return. So it's on a form 1065. It's different from the Schedule C that you see with the sole proprietorships, because there's one or more individuals that own or that have started into a business together.
And think of it as how easy it was to start a sole proprietorship. It's just as easy to start the general partnership. You just need two people saying we're in business. And we see quite often people that have formed a partnership and didn't even realize it. You know, a couple of guys, buddies that says, hey, let's go get a food truck. Let's do this. Well, without anything else, other kind of formal organization, they just created a partnership. And you got to be really careful because, again, it's a huge liability issue. And the sole proprietor, we were talking about, you know, one person's assets, you and your spouse have money in the bank. Now you've added another partner. Now you've doubled or tripled or quadrupled, depending on how many partners, the assets of things that are subject to lawsuits. So if Rita and I were to start a general partnership, we started a food truck, and she really wasn't working at the food truck, but I was, and I spilled the grease. All of her personal assets are still subject to lawsuit. So again, we're not trying to be lawyers. We're just trying to make you really think about this, pay attention. Generally, if you have any kind of a business that has a liability, if you're selling Mary Kay, there's not much liability. If you're doing Tupperware, there's not much liability. But if you're giving professional advice to people, if you're doing a food truck, if you're doing whatever that something could go wrong, then generally you want to make sure you cover yourself and protect all your assets.
Yeah, we see this a lot with people accidentally starting general partnerships with real estate. So two individuals will go in and they'll buy an office building together, thinking it's just an investment, when really the intent to profit makes it a general partnership, because they will be renting it, they will be having income. So then it kind of moves that into the general partnership. This is an active business type arena. So that's where we get most of the shock. Was like, are you kidding? I just went in and I just, you know, we just went 10,000 and we were fine, you know, but it doesn't work that way. If there's an intent to make money and there's two individuals initiating the business together, then that is what's going to trigger the general partnership taxation.
And the partnership files its own tax return. I think Rita mentioned that. It's a form 1065. So the partnership files a return which has the income and the expenses on one schedule. It's got what's called a balance sheet on the other schedule, which is assets, liabilities, the partners capital accounts. And the partnership does not pay any income tax. What it does is distributes the income to the partners, allows the partners to pay the income tax, and it uses something called a Schedule K-1. So let's assume the scenario that two guys went in to buy a building like Rita was just talking about. Well, they do the partnership tax return, and it's got, let's just make the math easy, $100 profit at the bottom line. They're 50-50 partners. Each partner will get what's called a Schedule K-1 that says you need to report $50 of income on your personal return. The other partner gets the other $50. So the $100 is reported, it's just on two different tax returns. And you would think that because each partner's getting $50, that they would both pay the same amount of tax. That's not necessarily true. Let's assume partner one gets the $50 assigned to partner one, but the partner one has a spouse that makes $400,000 a year. Partner one's going to pay income tax at a rate on that $50 based upon a $400,000 income. Partner 2, whose spouse doesn't work at all, probably won't pay any income tax because it's only $50 being allocated to them. So it's not always an even keel. It depends on if you're married, who you're married to, or your domestic situation.
And that's true for every pass-through entity, you know, so and when we say pass-through entity, these are the entities that generate that K-1, that pass the tax to you as an individual, instead of paying that tax with the corporate tax return.
And then your partners are also, in addition to the income tax, are going to be hit with the same 15.3% self-employment tax that we talked about as a sole proprietor. Also, as a general partner, as a partner, you are not an employee. So again, if it's you and somebody else, or you and 100 people, and you're all in a general partnership, you do not meet the IRS definition of an employee. You do not need to run all the formal payrolls. You are just considered a partner in your tax that way through the self-employment tax and the K-1 scenario.
Mm-hmm. So do we have any questions so far? I haven't seen anything come up on my end, but just want to make sure we don't have anything in the queue.
No questions so far.
Okay, thank you, Brittany.
But we've obviously confused them such that they can't even ask.
So, okay.
And then Rita mentioned we're going to leave out a limited partnership, but that's just another type of partnership that does provide liability protection, and you don't see them all that much. They're more for real estate investments and stuff. So we decided to skip that one for sake of time.
But if you have any questions about that, you know, you can always reach out to your attorney, reach out to your CPA or your accountant, or give us a call. We'll be happy to answer any questions that you have in regards to the limited partnerships that are out there.
Okay, the next one is a C corporation. This is your, typically historically, you didn't see this a lot with the smaller businesses. This is more your large IBMs and Dell computers, and a lot of these Exxon, you know, a lot of those are C corporations where you can buy and sell the stock really easy. Historically, you didn't want to be one primarily because the tax rate was pretty high. It's been 34% for a long time. And then a couple of years ago, with the latest tax reform, they lowered that 34% down to 21%. All of a sudden, the C Corps came into play with some of the tax planning and whatnot. Because if you're a partnership or a sole proprietor, and once you pass all that stuff through and your spouse makes money, you could be paying lower taxes on a C Corp at the 21%.
Because the C Corp is the only entity that we're talking about today that pays its own taxes. So this is not a pass-through entity. So we talked about the pass-through entities generating the K-1, and it passes through and gets reported on the 1040. But the C corporations file their own form, the 1120, and it pays, if it owes taxes, the corporation pays the taxes. And
when we say taxes, we're talking income tax, because all of these entities pay payroll tax, franchise tax, property tax. So we're specifically talking about income tax. When we say this is the only one that pays its own way. The administration that's in office right now has said their desire is to raise the tax rate on a C Corp from 21% to 28%. So keep all that in mind. If you're wanting to be a C Corp, keep in mind that that rate is volatile. It can change, and it may go up. Very likely it will in the next year or so. But one of the reasons you would want to be a C Corp is for fundraising. If you want to sell your shares and raise investment in your company, a C Corp is a good way to do that. There are very few limitations on who can be a shareholder. When we're going to get to S Corps in a minute, and there's only certain people, certain times that can invest in an S Corp. But if you really want to take in investors, you need to take a serious look at the C Corp just to be able to get that money in, and then you can make some changes later on, potentially. There is one item you have to watch though. You see line 6, it says subject to double taxation issues. A C Corp is very formal. Like we were talking about general partnership and sole proprietor. You can put money in, you can take money out, you can put assets in, you can take assets out. When you get into a C corporation, you're pretty formal and you can't just do that. You can't just go in and take out money without there being repercussions, taxation repercussions. So if you own a C Corp, you have to be on payroll if you want to get paid. Sole proprietor and partner, we were saying no. C Corp, all of a sudden you flip the switch, you have to be on payroll. So if you want money out of this C Corp, you either repay a loan to you take it out as payroll, or you take it out as what's called a dividend. And a dividend is where the double taxation rules come into effect. Let's say the corporation makes $1,000 before any kind of dividends. It's going to pay tax on that $1,000. Then it can distribute the dividends after that, but that money, that $1,000 being distributed as dividend has already been taxed. Corporation paid tax on it. When the shareholders get the dividend, they have to turn around and pay tax on it also. So those dividend numbers get double taxed, once at the corporate level and then the second time at the individual level.
Mm-hmm. Now there is a formal entity that you have to register with the state of Texas, or any state if you're doing a C Corp. But since we're in Texas, we're talking about Texas. So it is subject to the state franchise tax because of that formal setup process that you have to do with the state. So make sure that if you do any of these entities that we're talking about from here on out, there is a formal process to set up those entities. So now they're all going to be subject to the state franchise tax, which has to be filed in order to keep that liability protection, because that's what you have now with the C corporation, is that liability, or the corporate curtain. You might have heard that term before, that separate your business and your personal assets. So if there is a lawsuit, then they're going to try to pierce it. They're still always going to probably try to get to your personal assets, but it makes it a little bit harder.
So when we say a formal process, when you hear that word, we refer you to an attorney. Mm-hmm. Anybody can go set this up. You can fill out the form with the Secretary of State, send it in, and you'll be a C Corp. What you're missing is you may have filled out the form incorrectly, because there's questions you need to, depending on how you answer questions, define certain outcomes. You're going to need operating agreements, buy-sell agreements, all kinds of legal agreements to make this actually work the way you want it to. And we always will recommend that you go spend some time with your attorney. Mm-hmm. Have an attorney, get one. They're kind of a necessary evil once you're in business, but you need to get one and have them help you through some of this.
Yeah, because I mean, we get a lot of people that go to LegalZoom or anything like that. They really only do half of the process when they're setting up their entities. In this formal kind of situation that we're in, once we get into the C Corps, the S Corps, the LLCs, they only really do half of it. They go to LegalZoom and they fill out the forms, and they go the register it with the Secretary of State and all of that. But then they don't take that one step further and do the operating agreements or the membership agreements and things like that, the organization documents. They don't do that other half. And what we've been told by attorneys in the past is that if you don't do that other half, it makes it easier for individuals to pierce that corporate veil and get to your personal assets, because you're not acting like a C Corp or a corporation or a partnership. You only did half the process, so you only have half the coverage, so to speak. So, you ready?
I'm ready, always ready.
If there's not any question, if you get a question, Brittany, just go ahead and interrupt us, and we'll get them answered.
Okay, perfect.
Okay.
Okay, then there's something called an S corporation or subchapter S corporation. Most people have heard the terminology. They may not know what it means, but you're familiar with the terminology. An S corporation is a formal structure, but you do not go to the Secretary of State and create an S corporation. An S corporation is election that you make with the IRS of how you want to be taxed. So you need legally an underlying organization. You need to be a C Corp. You need to be an LLC, limited partnership, or whatever legally with the state. Then the S Corp election is purely saying, okay, IRS, I am whatever I am, but I want to be taxed under the S Corp rules of the Internal Revenue Code. So we'll talk in a minute about the LLCs and how that fits into here. So if you want to create something else first, then you elect with the IRS. There's deadlines for making the elections. You have to get approval. It's not a slam dunk. You send in the forms to the IRS. Again, the forms look pretty simple, but if you answer some of the questions wrong for not understanding what you're filling out, you can, invalidate the whole thing or create a mess. Basically, we get to participate in cleaning up messes periodically. But as an S Corp, like I said, you are something else below that, but you're going to be subject to the state franchise tax, property tax, all of which we'll get to at the end, sales tax, depending on what you're doing. The S Corp files an 1120S. So the C Corp filed an 1120, the S Corp files an 1120S, which is a different tax form than the 1120. And the S Corp distributes the income back to the shareholders, much like the partnership did. There is a K-1 form for an S corporation. So if the company makes $100 again, and there's two shareholders, each one with 50% apiece, each one would get to pay tax on 50% of that $100. There are no double taxation issues with an S corp, but there are some ways to take money out without dealing with the self-employment tax. We just always say be careful with that. There's limitations on how much you can take out, different rules you have to follow. But think about what the self-employment tax was for. That's for your Social Security and Medicare. So if you go S Corp route and you can play this game where you can get some money out without paying Social Security and Medicare, the issue becomes who's paying for your retirement, because all of a sudden you're not putting near as much money into the retirement system as you could. We always, 100% of the time, suggest that whatever your tax savings are from the self-employment side is use that money to fund your own retirement plan with the goal of being able to beat Social Security and Medicare and come out of it with a lot more money in the long run.
And one of the main reasons why the self-employment tax is not assessed on the subchapter S corporations is because once you make that election, you are required to be on payroll. So as an owner, you transition from an owner to an employee, and you now have to set up the formal payroll process with the subchapter S. So just make sure when you are making that decision and wanting to take that leap into the subchapter S arena that you are fully aware of what the formal payroll entails, because there is a lot of moving pieces when it comes to payroll and processing payroll, and it is one of the highest penalized areas in tax right now. So it's really cost beneficial for you as an owner to seek out help or pay a payroll provider, ADP, your CPA. Any of those people can help you process a payroll and kind of navigate the payroll world, because there's a lot of nuances and things on there that if you skip one, it could get you into big trouble.
And you've got to pay attention to your entity type also, like sole proprietor, general partnership. You can't be an employee. You shouldn't be. Mm-hmm. C Corp, S Corp, you kind of have to be. When we get into the LLC, it's going to be, it depends.
Mm-hmm. Are you ready?
Rita was saying the penalties are so substantial. If let's just throw one thing. There's an I-9 form that has to be filled out on new employees. You don't fill that out, I believe that the fine is $11,000 per employee for not having that form. If you staple it and highlight it or erase something, there's fines. I mean, it's fine. Not as good, but fine as if we're going to take your money. And you know, there's reporting requirements. You got forms going one way due with certain due dates. You got money going a different way with different due dates. You got unemployment, all kinds of issues that I totally agree with Rita. Just go get some help. Hire a payroll processor or your CPA to do it for you. They know how to do it. You don't have to worry about it. You move on and do what makes you money and quit doing your own payroll.
Yes, it's one of the #1 areas we see small business getting into trouble is in the payroll side. We're not going to talk about that today because of all the moving pieces, but we do wanted to make sure that we get that information out to you business owners as much as possible.
Okay, then there's the wonderful LLC that everybody knows and loves. We always make fun. We say you ought to go down your street and knock on every door on your street, and just when they answer, say, "Are you an LLC?" And probably half of them will say yes. And sometimes if you ask why, they don't know, but it was pretty cool. And somebody offered them a deal, or they went to Vegas and got in a seminar or whatever it might be. But LLC or legal liability company is very unique in the taxation world. The IRS does not recognize that there is such a thing as an LLC. They don't have any forms for LLCs. There are no tax forms. There are no tax rates. You default into or other types. So if you are a single owner, you create an LLC and you don't do anything, you don't tell the IRS anything, then they're going to default you and you will be taxed as a sole proprietor, which was slide #1. You're going to have self-employment tax. You're going to file the Schedule C, goes on the form 1040, et cetera, exactly as a sole proprietor. If you create an LLC and there's 2 or more owners and you don't tell the IRS anything different, then you're going to be treated by the IRS as a partnership. You'll file Form 1065. You'll follow the rules that we talked about on the partnership slide. But the fun part of this is if you don't like that, if you don't like the defaults, then basically tell the IRS how you want to be taxed and they will let you. So the most common thing that people do, we see it very often, is they will create their LLC and then elect to be taxed as a subchapter S corporation. It's kind of the best of both worlds. The attorneys tell us that the LLC is the best legal protection of any of the entities, or it's right up there if it's not the best. It's simple. You don't have all of these formal, build yourself a castle, you can't get out because of the walls type of thing that you'll have in a C Corp or whatever. The LLC is flexible. You can be taxed any way you want to. And here's where we get into the payroll issue. If you're single owner LLC treated as a sole proprietor, you're not an employee, you're still a sole proprietor. Multi-owner LLC taxed as a partnership, you're not an employee, you're still just a partner. An LLC that elects to be taxed as an S Corp, you are an employee. You have to put yourself on payroll. LLC taxed as a C Corp, you are an employee. You have to put yourself on payroll. So just because you're an LLC doesn't mean you're on or off payroll. You have to look downstream as to how it filters out, how you're taxed, and then that will tell you how to make sure you get on the payroll correctly.
And you want to make sure, because you have that open window every year from January to March to make this election, a lot of the times when we're working with our clients that are just starting a business and they're operating as a sole proprietor or just as a single owner LLC, and they have not quite met that profit line, that take home pay, that they're drawing out of the business, to make that sub-S election beneficial to them. So we always make sure that we kind of watch it. That's what you want to make sure as an LLC when you're first starting that you're taking home, anywhere from $50,000 to $100,000 in draws on profit side of things, so that you don't kind of kick off that bucket too soon, where you're almost already in this payroll, formal payroll, and having to pay the payroll taxes, and they're having due here and then they're due there, and you're kind of still in that cash crunch as a startup business. So you just want to make sure that the timing is right, that you're keeping track of your books, that you're making sure your records are right, so you're able to use those financial statements to know when it's the right time to make that leap from just being a single owner LLC or a multi-owner LLC into the sub-S arena or the C Corp arena.
And you also have to look at your ownership, because we talked about the ownership of a subchapter S is somewhat limited. You can't have foreign nationals. You can't have some trusts. Some trusts you can, some trusts you can't. You can't have corporations. Different things like that are not allowed to be shareholders in an S Corp. And let's assume you're an LLC or a C Corp and you have shareholders or owners that violate the S Corp rules. You cannot change to an S Corp as long as you have those owners. You have to get those owners out of the business before you can convert to an S Corp.
Mm-hmm.
And then one other thing is, when you do convert, 100% of the shareholders have to sign off on the actual election form. So if you got 50 shareholders, every one of those 50 have to sign to approve going to be an S Corp. So an S Corp is easier to start when your capital structure is very simple. The more you add to it, the more difficult it becomes.
Mm-hmm. But we do like the LLCs. We recommend it a lot. It is the top entity that we recommend for small businesses, just because of the flexibility. So if somebody does knock on your door and ask you why you were an LLC, you might just tell them it's because of the flexibility and the growth opportunities that I can get with it. And you can maintain your operational status and your legal protection status without having to jump into the S Corp or the C Corp areas. And so it does provide you a lot of room to kind of breathe and make decisions as you go. And that's probably the best reason to become an LLC if you are a sole proprietorship. It doesn't change anything operationally for you, but it does provide you with that state level protection. So, and that's something, as a disregarded entity, LLCs are only recognized on a state level. Like David said, they're not recognized on a federal level. So that's something to kind of keep in mind as well. So if you're going to be in multiple states, you might want to seek out the attorney's, advice and guidance and things like that.
Yeah, speaking of multiple states, I just need to throw it out there. If your business operates in multiple states, your complication levels just went up. So you cannot create a company, or you should not create a company in each state. Let's say you operate in Texas, Oklahoma, and Louisiana. You created your LLC in Texas. You only create it once. You want to operate in Oklahoma, you'll have to register in Oklahoma. It's what they consider a foreign corporation. It's foreign to Oklahoma. But you're still a Texas corporation registered in Oklahoma, or your Texas corporation or LLC registered in Louisiana, whatever it is. When you register in those states, you're potentially filing income tax returns in those states, franchise tax, sales tax, all of the taxes we're mentioning. Every time you go into another state, you may open up a can of worms and have to be filing all of those in the other states also. I think the most we've ever done was 19 states for a company we were working with.
Mm-hmm.
And you're talking about a involved bunch of tax returns. It's laying them out on the table 12 feet long, trying to get them all sorted out, and who's who and who's doing what to who. So it can get complicated. And we just suggest pay your CPAs more and more money and make them happy, and they'll take care of it.
That's David's number one tax planning strategy.
That is, it works.
Pay the CPAs more. So, well, that comes to the end of the entity section. So we're going to, so if we don't have any questions, we're just going to move right on to the bookkeeping systems and accounting methods.
I think they're asleep.
I think so. It's not the most exciting topic.
I'm still here.
Oh,
I think you guys are doing a great job.
Annie.
Why don't we
I've
just
actually learned a lot myself.
Okay.
yes. Well, do you want to ask like what kind of entities are on the call, just so you'll know?
Yeah, I mean, if
That would be nice. Yeah.
yeah, if people want to put that in the chat, that would be helpful. So, but I'm not sure if anybody's willing to.
If they know how to do it or not. There's a do you have a toolbar at the bottom, and you can see where it says chat. Oh, we do have a couple.
Okay. We have an
LLC and a sole prop and a sole prop.
Okay. Well, hopefully some of those things were helpful.
Couple of sole props. Yes.
Oh, good.
Well, good. So, well, good. If there's not any questions, we're just gonna, I mean, but feel free to ask your questions. You can put them in the chat. You can, you know, as we go, we love the interaction. That's kind of the number one thing we miss about doing these in person, is where we don't get to interact with the audience and get to know your businesses, you know, kind of thing. So please feel free to chime in or anything. That's what we love about these things. So, but moving on, we're going to be talking about bookkeeping systems and accounting methods, which are important to sole props and LLC. Not commingling your funds like we talked about before, making sure those things are separate, requires some sort of bookkeeping method or bookkeeping system that you have in place. We always recommend QuickBooks, just because it is the largest system out there that can do a lot of different things for clients, but there's a million different softwares and things out there that you can use that are just as good as QuickBooks. But talking about accounting methods, you have to select your accounting method the first time you file your tax return. So there's a little box that you check, and there's two different, there's cash and accrual, you know, so if you're checking the wrong one, it could kind of get you into trouble. So.
But basically what that means is, under the cash method of accounting, something is not considered income to you until it's made available to you. So if I owe you money and I hand you a check, it's not income to you until that money's available to you. So if I don't hand you the check until January, then it's not income to you until January. On the expense side, it works the same. You cannot deduct an expense until you actually pay it. So if I want to deduct the electric bill on my 2020 tax return, I need to pay the electric bill in 2020. Accrual, kind of the opposite. Accrual means, from an income standpoint, it's income to me when I earn it. So if I do work for you now, and what are we in April? I do work for you now, I send you an invoice, but you don't pay it for 6 months. It's still income to me in April under the accrual method. The expense side works the same. When I incur an expense, then I can deduct it. I don't have to pay it. So typically your accrual accounting is reserved for the larger companies. Probably 90% of smaller companies use the cash method on the tax returns. And they may use some hybrid method on their own books, because if you're tracking accounts receivable and accounts payable, those are pieces of accrual. Most small businesses obviously track who owes them. They may not track who they owe. But tax returns are filed generally under the cash method. And then you watch your books, and a lot of that's under the accrual. On the QuickBooks, they'll switch back and forth. There's a button you push. Show it to me accrual, show it to me cash. It keeps up with it. We just want to make sure you're aware that there's two choices out there.
Mm-hmm. Yeah, and you can change your accounting method, but you need IRS permission to do it. So I'd say that you can, but it's probably easier just to shut your corporation down and start a whole new one before you get, that permission from the IRS is a lot easier. there's a lot of stuff going into changing your accounting method. So just make sure most small businesses are operating on the cash and they're checking that box cash the first time they file their tax return, because that's when you make the election. Like I said, is when you first initially file that tax return. So, and if you're not going to, I think, do you remember what the new income limit is now for?
I believe it's 25 million.
Yeah. So as long as you are going to be less than, think you're going to earn less than 25 million. So it's still okay to do the cash, which is, it's the easiest way to do accounting.
Yeah, I'm not worried about the 25 million.
Not today anyway.
And then we're going to give you some, basically an IRS definition of how good you need to keep a set of books, but it's, you can read it also. Automated systems, which is your QuickBooks, your Sage, your what I don't even Wave, some of those other ones. They must produce sufficient legible records to determine your correct tax liability. So now you know exactly how you need to keep your books.
Mm-hmm.
Yeah.
What that really means is that the IRS now has the capability to pull backup copies of any of the accounting systems that you're using, even if you're using Excel, if you're using QuickBooks, if you're using Wave, Sage, or any of the other products that are available. They have the right to request access to that information so that they can audit and compare your actual bookkeeping system to what was actually reported on the tax return. So that makes it even more important to make sure that your records are, kept, that you keep track of your records in an orderly way and then translate them to your tax return and make sure those numbers match at the end of the year, and then don't change them.
Yeah, because that's something we see a lot. You turn in a set of records, we prepare your tax return 2 years, because usually it's 2 years, roughly 2.5 years after you file when you get audited. IRS will come in and say, give me the QuickBooks. You give them access to your current QuickBooks and you've changed a bunch of numbers. Mm-hmm. That's good for an audit. But it's very common for you to see something, oh, I forgot to put this is from December, I'll go put it back in December. It's like, no, you've already done your tax return, don't mess with that. Mm-hmm. It's going to cause problems later. So yeah. That's what we're talking about. Once you turn it to your accountant, let the accountant make any adjustments, but then after that you freeze it and don't go back and touch those older years.
Yeah, and I know like QuickBooks, Peachtree, Sage products, and even Wave Financial, because those are the ones I have experience with. They have locking mechanisms where you can lock the year up, and you can password protect it if you need to. So we use QuickBooks Online with our clients. So what we do is when we go in to prepare your tax return, we do any of the journal entries that we need to do, and then we lock it up with a password that we have. That way, when our clients are doing their data entry and they're wanting to put something in a closed period, we're protecting them and making them call us when they need to post something to a previously closed year.
Some of them we refuse to give the password to.
Right. But
no, you promised.
Yeah, but most of these systems that you're seeing, these bookkeeping systems, they're going to be on a double entry accounting. Like they follow the double entry side of accounting methods. Single entry side is more of like a Quicken or a checkbook type of, like if you're just operating off of a checkbook or doing a spreadsheet, that's going to be kind of more of your single entry. It's just one-sided, doesn't provide any sort of financial statements, and it doesn't produce, a balance sheet or maintain a balance sheet. Whereas a double entry accounting system with the feared debits and credits and all of those, accounting terminology that's in another language that nobody really understands, that's the double entry. And most of the accounting systems that you're going to see out there are going to be based on the generally accepted accounting principles that are out there right now. So in the beginning, any accounting system that you decide to use, get somebody to review it, have somebody help you set it up to make sure that you're setting your base, that you're building your foundation correctly, so that as you add to it, it doesn't fall down like a house of cards.
Okay, and we had a question that popped up, which is they use QuickBooks, what's the most popular? And I think the consensus right now is QuickBooks is the most popular.
Yeah, QuickBooks, yeah.
I was going to say there's a desktop and an online version. Mm-hmm. You can still buy the desktop, but that thing is being phased out pretty quickly. Mm-hmm. And don't expect a lot of support from Intuit or from the people. They really want you on the online version. There's like 4 or 5 versions of the online. You want to make sure you pick the right one, but right now I think QuickBooks is the most popular that we see.
Yeah, currently, but Wave Financial, it's a free application that's out there, and I'm not promoting it. I'm actually a certified QuickBooks Pro advisor, so I'm actually supposed to be pushing QuickBooks more than I am the other. But Wave Financial is actually pretty good for the small business communities, you know, that don't have employees, they don't have anything really complicated, and you're just starting, but you still want to produce a balance sheet and you still want a P&L. It's a free application that's out there, and it's easily transitioned into, you know, a Sage product or a QuickBooks product. Once your growth gets to a certain level and it's no longer a viable product for you to use, because there is like, once you get to a certain size, it's probably better to be in one of those other platforms. But it's actually really good for just those little sole proprietors that are out there working and just need something simple to produce some simple financials and keep track of their expenses for their taxes or other growth strategy opportunities. So yeah. But get some help. That's our biggest thing whenever you're designing or setting up your bookkeeping system, or choosing an accounting, you know, program that you're going to use, is just get some help and kind of vet it. Like you said, we prefer QuickBooks, but that's just because it's been around for a long time, and it has so many capabilities, you know, and it can stay with you for a really long time for a minimal cost, you know, which is why we like it a lot. So, are there any other questions? I don't see any. So
No, I think we got that one.
okay.
Okay, so the records, like we said, the IRS is not real specific, obviously, in what you should keep, how you should keep your records. Again, this is some of their wording. Records must be sufficient to substantiate items of income, deductions, and credits, enable you to prepare complete and accurate tax returns, identify source of receipt, document nature and business relationship of a deduction or credit. Most of that you're going to get if you use an accounting system, a QuickBooks or whatever, you're going to get the majority of that out of the accounting system, but you need to do, you need to be able to put the information in there. If you're paying Joe Blow for something, the systems need to say, I'm paying Joe Blow and this is what I'm buying and this is what I paid him. That's the type of data that you can cut and sort and parse when you get around to doing your taxes, but you got to get the data in the system to be able to pull it back out.
Mm-hmm. And we still recommend receipts. Like we still recommend that you keep a copy of those receipts. In programs like QuickBooks and things, you can attach the receipts right there. The IRS does accept electronic copies of receipts, or PDF files and things like that of receipts and supporting documentation for those expenses that you're putting into your accounting system. But we always want to make sure that they don't really like you just to plop down like a credit card statement and say, well, this is where I spend my money, you know, because there's things on there like Walmart and HEB or Big Lots or different, you know, different places that you can buy not only business business expenses that you want to use your money on, but you can also purchase personal items as well. So they want that extra detail to be able to see that you were actually purchasing business items that you were using for the business, and not, you know, including a bunch of personal items on that receipt as well.
And then keep a little bit of extra detail when you're traveling or you've got some entertainment or business meals. They don't care that you went to Starbucks for coffee. They want to know who you were at Starbucks with and what you talked about. I went and met Ron Smith and we talked about the future of collaborating to do a joint project. I mean, you need to be able to keep those type records. You need to be able to prove a valid, legitimate business relationship, or these expenses are not going to be deductible.
Mm-hmm. Okay. Ready?
Yep. And then the next question we always get is, how long do I have to keep this stuff?
Yes.
Well, keep it as long as it's material to your tax situation. Generally, and this is a very, very general, please don't take this to the bank, 3 to 5 years, because certain records have different requirements. But when you file your tax return, if we filed it today, there is a 3-year statute that says the IRS needs to audit this return if it's going to within 3 years from today. 3 years from tomorrow is too late. They really can't unless they they suspect fraud or whatever, and there's all kinds of reasons they can do that. Or if they come in and audit you a week before the statute expires, and that happens, they will go, I want you to sign this form to extend the statute, and if you don't, I'm going to disallow every expense you have on the tax return. They kind of back you in a corner, so you then agree to extend the statute. So keep your papers generally 5 years with some exceptions that are longer.
Mm-hmm.
Employment tax records, payroll type stuff, copies of W-2s, copies of your I-9s, all of that, 4 years from when due or paid, but I would add another year or two on there just to be safe.
Mm-hmm.
How about records relating to the basis of assets must be kept for the life of the asset plus the 3 years. Let's say you bought a building in 1969, you still own that building, you sell it in 2021, you've got to have all those records from 1969 all the way through 2021, and then keep them for 3 more years, file the return. So as long as something is relevant to your tax return, you're gonna have to keep that paperwork.
Mm-hmm. So tell your parents if they're planning on, leaving you the house, because you want them to make sure they have kept their paperwork from when they originally purchased their home. So, it kind of extends into that arena as well. So if you're inheriting things, they want to see the records from the original purchase as well. So
Change accounting methods, like we said earlier, we were talking about changing from cash to accrual.
Brittany, did we lose David and Rita?
I'm not sure what happened. I'm glad you're still here, Annie.
I'm here. So I'm not sure where you left off. I'm back. I don't know what happened.
Yeah, David is definitely gone.
But maybe he'll be back. So, well, I'll just keep going until he gets back, I guess.
Okay, thank you, Rita. I'm sorry.
No, that's okay. That's okay. So I think, so basically when it comes to the exceptions on the record keeping, I'm not sure where he left off, but if you're not sure how long to keep something, make sure that you just reach out and ask somebody. It's not, and then now with technology, you can scan and keep things, and store things forever and ever and ever and ever and ever without having to actually keep the actual physical documents, so that's helpful too with people that are just not sure. I have clients that had sheds, they built 4 or 5 sheds to put their documents in it, just because they were so afraid to actually throw anything away physically, so we kind of got them, transitioned them into the new age and be like, you can scan all of those things and then maybe you can have your backyard back. So there are, because the IRS accepts electronic copies, there are ways that you can do that. There he is. So David's back. Okay. So now we want to kind of talk a little bit about one of the hot topics. We're just kind of insert this in here just because we're not talking about payroll in particular, but we did want to make sure we covered this today, just because the employee versus contractor issue is such a hot topic with the IRS and something that they are looking at pretty regularly and heavily here for the last 4 or 5 years anyway. And they're probably just going to continue that trend, the more money that they're looking for. So we kind of recommend that if we don't want to say don't hire contractors or make everybody employees. It's not really that black and white. It's a little bit of a gray area. So we kind of came up with this trick to kind of guide our clients in the areas to navigate the employee versus contractor. Because really what it comes down to is not, you can't just start a business and say, oh, I'm just going to make them all contractors. Because I don't want to start payroll. I don't want to mess with any of that stuff. I just want to have contractors and just pay them, but it's not necessarily that easy just because of the amount of control or what you're having them do. So that's where the trick comes into play. If you are providing the tools, it's kind of a pendulum swing, kind of a balancing act. If you're providing the tools to those individuals, if they don't have a risk of loss, like whether or not they perform the job, you're still going to pay them $600 or $800, and they don't have any chance of losing any money. You've guaranteed them amount of money. If they're super integral to your business, if that individual walks away from your business and takes everything with him, like your business would shut down if that person was not working there. And then the amount of control, all of those things are going to swing this person more towards the employee side. So if you're doing any of those things, then you may want to consider making them an employee, and it'll save you some penalties and things on the back end, and a lot of trouble. You just want to kind of avoid the trouble side of things when it comes to payroll. The control piece is the biggest piece of deciding whether or not somebody should be an employee or a contractor. If you have so much control, if you're telling them when to come, when to leave, if you're requiring uniforms, if you're requiring a certain type of presence or a certain type of task done in a particular way, if you have a policies and procedures manual that you're requiring them to follow, that is the control that they're looking for. That means that you have too much control over this individual for them to be a contractor. So like I said, it's about a balancing act. It's kind of a pendulum. So if you're swinging more towards it's not one or all or any, it's just pieces of all of these little things. So if you find yourself more on the employee side, it's probably safer to make them an employee or change your processes or change how you're doing business with those individuals to make them a contractor. You just want to make sure you're building your case ahead of time. Make sure that they have a contract, and in that contract, somewhere in that contract, it states that they understand that they are not an employee, that they will be responsible for their own taxes, that you want to make sure that they fill out a form W-9. And then if at all possible, you want them to submit you invoices instead of timesheets. Try to kind of stay away from anything that would kind of denote them being more of an employee, like employee habits where they submit timesheets and they clock in and clock out, that sort of thing. You kind of don't want to do that with your contractors. You kind of want to let them have their anonymity and their freedom of being able to kind of come and go and do the scope of work on their own time. So that's more of a contractor type relationship than an employee-employer relationship. Now that you're back, David, do you have anything to add?
I lost the internet. It just died.
I did.
I mean, this is something that the IRS asks you on a tax return, on a business tax return, even on a Schedule C for a sole proprietor. There's a question. Did you have anyone that you should have sent a 1099 to? Yes or no? Mm-hmm. And the very next question is, did you? So you could say, yes, I should have, but if you didn't send them out, on the next line, you have to say no, mm-hmm. or you need to get them sent out real quick. And used to, you might get a $50 penalty here and there. Now they've really ratcheted up the penalties. There's like 3 levels, and it could get up to what, $350 per one you didn't file, or
mm-hmm. Yeah,
it's really got expensive. But don't worry, it'll never be over like 5 million. They've got caps out there.
And they did put like a $5 million cap on the penalties. So, but the other thing that you have to keep in mind is if the individual thinks they're an employee, that they don't have the definitions kind of scope like measured out in their head, they think they're an employee. And you have to terminate services with this individual, and this individual thinks they were an employee, and they go down to TWC and they say, I want my unemployment. And they say, well, were you an employee? They say, yes, I was. And then the TWC is an advocate for the employee, not the employer. So that's the whole reason TWC was designed, was to be an advocate for the employee. So the TWC is going to automatically assume that they were an employee, and then they were going to come in and ask you questions, and then you're going to be in an audit situation. And if the TWC deems that they should have been employed, and not a contractor, but you paid them as a contractor, you're going to be liable for all the taxes and everything that was due for that employee. Because they're making that decision, because it's about what they do, not what you name them, so what they're doing for you really, really matters, and how they do it for you really, really matters. So make sure that if you decide that you want to have all contractors and not employees, that you kind of build your case ahead of time and make sure you have the appropriate documentation in place to support that in those audit situations. Because there's the Information Sharing Act. So once you get audited by one agency, it's just going to domino to all the other agencies, and that's where it gets to be.
She's bringing forth a really good point. And like, if you get arrested for a crime, you go to trial, you're defending yourself. All you got to do is get a reasonable doubt. Basically, the government or the prosecution has to prove that you're guilty. When you're dealing with taxes, when you're dealing with the IRS, with the state, you are guilty unless you can prove yourself innocent. It is exactly the opposite. So in the case Rita was talking about, that the TWC will side with the employee 100% of the time. It is then you as the employer, you have to prove that no, that's not the case, and you have to show documentation, et cetera, et cetera. So you've always got to be prepared, but it's on your shoulder to prove you're innocent.
Mm-hmm. So if you have any, we're big advocates of seeking help from individuals and professionals that specialize in certain areas. So if you have any questions on whether or not this person should be an employee or this contractor, because there are some exceptions where they have to be employees, and some exceptions where they, traditionally have always been contractors, but you don't have to have as much documentation. So there are specific situations that lean towards, one way or another way. So in every business, everything is unique. So we always want you to seek out help, ask as many questions as you can to those professionals that's their job. That's their focus, so they're going to know the answers. And so don't just guess it or go with your gut feel, make sure that you're seeking out that information to help protect yourself as a business owner,
And if they are a contractor, then you get to fill out more tax forms.
Right.
We're fixing to talk about.
Right, which comes to the information returns. So the 1099 NECs and the 1099 miscellaneous. They used to be one form, now they're two forms, just to make things easier. So, so the non-employee compensation, that's the NEC, the 1099 NECs. So those are sent to any qualified vendors, not just contractors, because I know we talked about employee versus contractors, but the 1099 NECs are to qualified vendors. And the definition of qualified vendors is anybody that has performed a service for you that is not incorporated, that you paid more than $600 to. So that's a qualified vendor. So it includes your contractors, but it doesn't exclude any other service industry like CPAs, like your IT professionals, or any other service industry that have come in and performed work for you, business to business. This is not individual to business. It's always business to business.
And if you're in doubt, send the 1099 just to protect yourself. You don't get in trouble for sending out one that you didn't need to. Mm-hmm. If you send it out, make sure you have the right dollar figures on it. We have a lot of issues where the dollar figures are wrong, but and then the deadlines are really, really quick. The 1099 NEC must be filed with the IRS and filed with the qualified vendor by January 31st. So you've got a month to close your books, get all your W-2s and all that stuff done for payroll, all your 1099, all of that's got to go out in January. And we lovingly call January the month from hell. because it basically is trying to get all these sets of books closed, all the 1099s out, the W-2s, all the payroll stuff. It's kind of a crazy month.
Mhm. But that's where getting those W-9 forms for those qualified vendors ahead of time is going to be the most beneficial for you. That's going to take, half of your headache away. Keeping good records throughout the year, making sure you get those W-9s as you go and not just waiting until the end of the year. Those are some helpful tips that'll help, not have a January month from hell like what we go through, but you're, building those things ahead of time, watching, if somebody's performing a service for you, give them a W-9, ask them to fill out a W-9, ask them to send you a copy of it, because that W-9 is what's going to provide you with the information you need to fill out the 1099s and also to qualify them for a 1099. That W-9 is going to tell you whether or not they're incorporated or a sole proprietor or an LLC taxed as a corporation, because if they're an LLC taxed as a corporation, you don't have to send them a 1099. So there's all of that is provided with the W-9.
And it's your protection. If you do get audited, it is your protection for not sending 1099 because the qualified vendor told me this. You can rely on that.
Right. Now, there are instances where you can have certain contracts that have all that information in there. As long as it has everything that's on that W-9 form, that'll help protect you as well. So if you're doing contracts, making a contract with those contractors, that are qualified vendors, and in that contract, you have their name and their, EIN number, and you have, what type of entity they are and how they're taxed. You have all the information that's on the W-9 in that contract that would suffice to, as far as protection comes when it comes to the 1099 filings time. So,
Okay. Next is franchise tax, right?
Well, the 1099 miscellaneous, because they
Oh,
sent
sorry.
two forms. So we have the 1099 NEC that we just talked about for the non-employee compensation. The miscellaneous is about 30 other things that are not non-employee compensation. So non-employee compensation is what you're going to give your sole proprietors, and that's going to subject them to the 15.3% self-employment tax because they have their NEC. Where the 1099 miscellaneous for rent, attorney's fees, other income prizes, healthcare, fishing boat proceeds. There's about, probably 12, 14 different items on there on that 1099 miscellaneous. And each one of those boxes have different taxation rules. So you just want to make sure that you're putting the information in the right box. And, so if you're sending somebody a 1099 miscellaneous for rents that you've paid, because that is a huge, we have to send somebody a 1099 miscellaneous for rent. If you paid rent to a individual or corporation, or then you need to send them the fill out the 1099 miscellaneous and send it to them so they can report it on their taxes.
And we're only talking about 2 1099 forms. There's actually about 30.
Yes.
Dividends, all kinds of other ones that you need to watch out for and make sure you don't have to file those.
Yeah. But as business owners, these are the two most common ones that are due at the end of January. Well, the miscellaneous is, I think you get an extra month now. But depending on your industry, there may be other forms, other 1099s that you are required to file, but these are the two most basic ones that most small businesses are dealing with on a regular basis.
Now can I talk about franchise?
So now can I talk about franchise?
Now you can talk about franchise tax.
Okay, thank you. We've been back at the beginning. We kept talking subject to franchise, not subject to franchise tax return. Now we're going to tell you of what that is actually. It has nothing whatsoever to do with McDonald's or Dairy Queen or franchise like that. It's a terminology that the government uses. A lot of states have a franchise tax. Basically, it's a privilege of doing business tax is another way to word it. So if you want to do business in Texas and you want to have this legal entity with the liability protection, you're going to pay something called a franchise tax. And you got to be pretty good size before it really matters. There is a dollar limit. This is a sales or total revenue. It's your sales plus interest income plus anything that positive in the bank, basically, they add together. If you're less than $1.18 million in receipts, you're not going to owe a tax for the franchise tax. However, you do have to fill out the forms. If you don't fill out the forms, then you're going to lose your liability protection. You're going to lose your entity. The state will take it away from you, basically. So even if you got 0 sales, you have to file the franchise tax form. It's very, very simple. If we're doing your taxes, we just fill it out as part of doing the tax return. It's taken care of. It's all electronically filed. No big deal. If you are over the 1.18 million, then it's going to be based, there's some calculations involved. You have a long form, a short form, different ways to play it, but basically you get to subtract your cost of goods sold if you have any, and then your compensation, various formulas. But anyway, most of our clients are under the 1.18 million, so it's not a big deal. There's a story here. It's just make sure that you file the return and not forget to. It's due May the 15th normally. This year it's due June the 15th, not July. No, it's due June this, yeah. IRS is due in June too. I can fix.
You're thinking of last year, yeah.
I know.
But keep in mind too that the revenue line, the 1.18 million, that's a moving target. So the state can come in and raise that or lower that as often as they want to. So just make sure that you keep an eye on that number, because it's been as low as what, David? How low?
100,000. I think it started at 600,000. Yeah.
So it's been a little 600,000, and which hits a lot of the small business community, but it's been as high as I think it was like 2 million at one point, and then drop back down again. So
and I expect it to go down with the state needing money.
Yeah. So just make sure that every year that you're kind of keeping an eye, reach out to your CPA and say, hey, what's the limit this year? Hey, blah, blah, blah. So that for tax planning purposes that you have 2 targets to monitor. You have your franchise tax that you've got to monitor. Am I going to go over that threshold? Am I going to have to pay that tax rate? And then also for your income tax, so your federal income tax, you want to make sure that you're monitoring both of those at the same time. We don't like those kinds of surprises at the end of the year where it was like, oh, I made 2 million. So now all of a sudden you have franchise tax to pay in addition to your income tax. And those are not the surprises we prefer. We like flowers and candies and things.
We like good surprises.
Right, good surprises.
Okay, and there's one thing left we want to make sure we cover. And again, this is something we were mentioning it up front, a personal property tax. And our experience is probably 95% of people who started a new business have no idea that this is even out there. This is not a state level issue. This is a county issue. So if you own a home, it's very, very similar to the process of the real estate tax that you pay on your home. Somebody somewhere appraises your home, come up with a dollar figure. They send you a notice, tell you how much it's worth, gives you an opportunity to protest it if you want to. Otherwise, you're going to get a bill for X amount of which you have to pay. Personal property tax is everything except for real property. So we're talking desks, we're talking computers, we're talking machinery and equipment, we're talking vehicles, we're talking inventory. All of that is considered personal property tax by the counties, and they want to tax you year after year after year. They want to tax you on this stuff. So what the process is, there is a property tax rendition that if the state, or I'm sorry, if the county has you in their system, they're going to send you this property tax rendition late January, early February. Typically, they're due back on April the 15th. And on this form, you have to fill out, I bought a new something machine for X dollars. Any new asset additions that you buy, you have to put on there. You have to put on there the value of your inventory, the value of your vehicles, whatever it might be. You turn this in, the county then looks at it and send you the notice. Okay, we're going to assess you X, and usually that comes in May time frame. You have a little bit of time to go protest it, not very long, so you need to get down there pretty quick. Otherwise, you get the bill in October, very much similar to the real estate, but it is a tax to the county appraisal district. And we always try to point out, if you're working from home, a sole proprietor working from home, chances are the county has no clue you're there and doing that. We don't recommend you hang a sign out in the front yard that says I'm doing business inside the house as a sole proprietor, but generally the county's not even going to know you're there. And a lot of these, depending on the county, they'll have a box that says, you know, all my stuff added together is less than 10,000 or 20,000, whatever the county says, and you may even be exempt from this, but aware of it. Go onto the website of the county tax assessor, study the rules, and make sure that you're compliant with them. It's not a huge tax either. Generally, it's, for most small business, it's a couple $100.
Depending on your industry. So I always like to put that up. For us, it's not that much because our personal property that we have is desks and computers and things like that. But when you're looking at like used car lots, when you're looking at trucking companies, like their personal property that they have, because their trucks, their trailers, all the used cars that they have on the lots, all of that other stuff, as of December 31st of the previous year, that's what the number that you're reporting on those forms. So as of December 31st at midnight, what do you have on your lot? What do you have in your inventory that you purchased this year that we can tax you on? That's why at the end of the year, you see all those big car sales, you know, you're in sale, everything's got to go. It's because they don't want to pay that personal property tax on all of those vehicles in their lot. So that's probably the best time to buy a vehicle, by the way. So
if you wanted to avoid paying a couple $100 in tax, you could sell all your assets in December and turn around and buy them all back in January, right?
So
I'm helpful.
You're very helpful, David.
Thank you.
So, but that's everything I think we're trying to touch on today. We're still 2 minutes over. I hope we'll be happy to stay for any questions though, if there's any questions.
But I do want to throw out there that we are a small firm that really believes in education. That's one of the reasons why we do these webinars. If you go to our website, PlemonsCPA.com, we've got workshop schedules of things we're doing, topics all across the board that are related to small businesses. We have a bunch of podcasts out there from small businesses. We call it the hustle, juggle, and struggle of small business, and people kind of telling their stories of what they've been through and how they recovered from it, et cetera. And they're pretty interesting. So you go out there, it's all free.
Yeah.
Listen to it and have fun.
And we added a links and articles page on our website that'll have so news that is pertinent to the small business community, things that people would need to know. We started our QuickBooks Corner blog. So if you are having problems with your QuickBooks, we'll be, that'll be rolling out in May, where we'll be able to, answer some little questions and hopefully help guide you through some of those little issues that you're having with managing your QuickBooks and everything. So hopefully we got everything.
Yeah, I mean, if you have any questions, you could send them to admin@PlemonsCPA.com. Or if you want to actually meet with us, go to the website and click on Let's Meet, and you can set up your own meeting. It's all automated that way. So, look forward to it. Thank you for attendance today.